Most people think in San Diego, the real estate market is just about interest rates and the prices of homes. But in 2026, we're moving into a more interesting market where you're gonna wanna see why money is moving, where the money is moving, and why the increasing cost of home ownership directly is affecting pricing. And here's why these matter to you. These shifts directly affect pricing, competition, long-term home prices, and if you understand these ahead of time, you'll be able to make better decisions whether you're buying, selling, or even holding real estate. Before diving into this, let's just briefly discuss the San Diego real estate market and where it's heading into in 2026. San Diego is still one of the best places to live in the country because of the weather, because of the job market, because of the quality of life here. It's just outstanding. That's all important because long-term demand to live in San Diego isn't going to go away. But in the meantime, the short-term conditions in San Diego have greatly changed. We're seeing a softer economy with higher costs of home ownership, more regulations, and more political policies that are being passed that are having a direct impact on the housing market. When you combine all those things together, what it means is you have a better market for buyers. For homeowners, it means understanding where your value is protected and where it isn't protected because of this changing environment. Markets just don't turn overnight. They shift quietly and softly in the darkness of night. One of the most significant trends in San Diego is the growing challenges that landlords are currently facing by state and local policies. California, I mean, you may not know this, shocking, but it's been one of the toughest states on landlords and protecting landlords' rights by a huge margin. And this is only continuing to get worse in 2026 thanks to the current political policies in California. One of these new great California laws, if you're a renter, I guess, is the California law that's going to require landlords to automatically make sure they have new refrigerators, new stoves, and all their units if those appliances are over 10 years old. Now, this new ruling may sound petty because you just simply say, oh, it's just a refrigerator and a stove. Unless you're a landlord and you own multiple units and you now have to start replacing all of these things all the time. Now, does this open a gateway for more buyers to take advantage of landlords that don't want to do this all the time and they're offloading properties at discounts? Yes, it does. Landlords only have a certain stomach for risk, and once it goes too far, they sell, and usually at discounts, which is great for buyers. Now, something new that the state's looking to have everyone vote on is this new tax. I know, another tax in California, shocking, but it is a new tax on short-term rentals that they want to increase to $5,000 a room. Now, a lot of short-term rentals already barely worked or were making a good amount of profit. But if you start adding all these different taxes, that margin goes away quickly, and all of a sudden that rental may not be worth keeping. With additional taxes, properties don't pencil, which means landlords sell them, which means opportunities for buyers to come in once again because the landlord wants to get rid of that property. Now, the upside to this new short-term rental tax is for people that want to live in family-oriented neighborhoods, getting rid of all these short-term rentals makes your family neighborhood better. So remember, we talked about some neighborhoods in the beginning will retain more value. Getting rid of short-term rentals and family value and family areas actually increases the value of those homes. Policies don't crash markets, but all of these taxes on tax and rules and regulations slowly creep in and slowly make markets not worth being in as a landlord. Now layer all these new rules on top of what landlords are already financially dealing with, and the picture starts to get a little bit dim. These are some things you want to look at because they will matter in 2026. Here's a fact that homeowners and renters both need to think about of what's been going on for the last 2 years. Rents in San Diego have been slowly decreasing, are remaining consistently flat, but overall, most rents have seen a 5% decline. Combine this with the cost of home ownership going up. You take a look at things like your insurance costs in San Diego. They've gone through the roof. They're only gonna continue to get worse. Your water bill, we're in a desert. It's only gonna get worse here. And San Diego's already telling you they're gonna continue to jack up the prices. Then mix that with new property tax assessments, which are consistently coming out as well, along with the new trash tax tax that San Diego voted on and approved as well. All these things combined make being a landlord or homeowner in San Diego very difficult. When you tie all those things together, it makes you wonder, when there's not as many investors out there looking to buy in San Diego, competition goes down, which means if you're a buyer looking to buy for your family, it gives you more options. Factoring all those things together, it gives you more breathing room and basically points to an overall cooling environment in San Diego for our housing market, which I believe is what we're going into in 2026. It's going to slowly cool down a little bit. When income gets tighter and expenses get higher, people adjust, especially investors. Investors are no different than anybody else. And you're going to see a lot of money moving in San Diego, out of San Diego. A lot of large institutional investors are leaving San Diego. Number one, Irvine Company. Irvine Company is exiting downtown San Diego. They even sold a lot of their holdings at 50% off. They're moving their money out of that area because it's not profitable to be a landlord. The outlook is bleak and they have to put their money to work in other places. That capital is moving to UTC and UTC La Jolla. Why are they moving there? Because there's a lot more opportunities there. People will pay more money for rent there. A lot of more businesses are moving there. And it's one of the few places in San Diego where they're building a lot of new infrastructure all around a long-term plan of having a mini city in that area. So if you think about the UTC area, the UTC La Jolla area, that's one of the areas where prices are probably going to go up because it's in more demand. So if you're going to sit around and wait for prices to drop in UTC and UTC La Jolla, that's probably not a good bet. If you don't like that long rant I just went on about UTC and La Jolla, just follow the big money and see where all the big money is going. Zoning changes have probably been the biggest change in 2025 in San Diego, and that's going to continue to affect San Diego in 2026. By changing the zoning laws, San Diego is basically transforming, enabling you to build multi-units everywhere, ADUs everywhere, and now building lots of high density apartment complexes all around trolley systems. UTC La Jolla is one of them. And also transforming complete neighborhoods like Claremont that used to be majority of single family houses are now multi-units everywhere with no parking. So that means that single family homes in the future are going to be worth a lot more money than they are now. Buy and hold, my friends, is a strategy that always works, especially with single family homes. So when you put policy costs, capital movement, and zoning all together, you have a whole market that's starting to transition. This means a buyer window may be forming up. As investment activity declines in San Diego, it gives rise to opportunities of competition to lessen, which makes buying a home or a condo easier. A softening economy equals a softening housing market. We've already seen the economy slowing down a little bit. You see longer days on market for homes that are listed for sale. You see price reduction, price reduction, price reduction, all of these things coming into play now. And as you see the labor market continue to slow and the potential wild card of what's going on with tariffs, all of these lead to uncertainty. And uncertainty means buying opportunities as others are trying to get rid of their property. And lastly, who wins in the long term? Single family housing wins in the long term. Why? Because we're not building more of it. When you're not building more of it, it means the price is gonna go up. And in the future, people are still gonna have families. People are still gonna wanna live in high quality neighborhoods. So if you already own in a high quality neighborhood, hold on to it as long as you can because location is golden. So what does this mean for you in 2026? This is the way I would look at it if I was jumping into the housing market. I would be patient. I would move slow. I would follow where the big money is going. I would look where money is exiting. If money is dramatically exiting a certain area, can I step in and gut someone and buy their property at a 20% discount or a 30% discount? If I'm looking to raise a family and live here long term, I'm buying location, I'm buying the best neighborhood, and I'm buying away from all these new high density apartment complexes being built. Overall, real estate is a long-term adventure, so you need to plan your goals accordingly. Whatever you want to buy, it's a minimum 5 to 7 year hold, and just take your time, move slow. And if you need help with that, reach out to me because I'm not afraid to tell you no, not to buy. Thanks for watching my video. I hope you got value out of it. Write me comments below. For those of you haters, I love seeing your comments too. Write them below, and I look forward to making another video for you. Thank you.